Every day, capital is lost by traders staring at price charts without a plan, waiting for an intuition that never comes. Moving through the market without a system is like wandering through a maze where every turn is dictated by panic. Trading without a setup is like cooking a complex meal without a recipe. You might have the right ingredients, but without a specific sequence and measurements, the final result is unpredictable and often a waste of resources. To solve this, we are going to build a customized 6-part trading recipe. This framework acts as a mathematical filter, requiring specific market conditions to be met before a single dollar is risked. Get a pen and paper ready. This document will serve as your primary filter, determining which opportunities are worth pursuing and which are simply noise. Step 1 is the setup. This defines the why. It outlines the broad, large-scale market conditions that must exist before you even consider a trade. This chart shows the concept of a broad setup. Look at how these rectangular support and resistance zones frame the price action. Your setup might be as simple as waiting for the price to pull back and touch one of these specific areas. Think of it like crossing the street. You have a checklist. Look left, look right, check for cars. If the conditions aren't met, you stay on the sidewalk. Once the setup is present, we move to step 2, the entry rule. This is the when. It is the exact split-second trigger that tells you to click the mouse and enter the market. This chart illustrates a clear, repeatable entry rule. While the setup gets you interested, the entry only occurs in these yellow boxes, specifically when a candlestick physically touches the red 50-period moving average. The setup identifies the right neighborhood. The entry rule identifies the exact door. Having both removes the need to guess if now is the right time to buy. Step 3 is the stop loss, the point where you admit the trade idea is wrong. It is a mandatory financial seatbelt designed to preserve your account equity when the market moves against you. As shown on this chart, a stop loss isn't placed at a random dollar amount. It is positioned based on market structure, specifically below recent swing lows or key resistance levels, where the original trade logic would no longer apply. Step 4 is the target. This is your destination. You must decide where you will take your profit before the engine is even started. This chart demonstrates how to set a target using mathematical multiples. The green shading shows target levels projected at exactly 1, 2, or 3 times the distance of the initial risk. By defining these 2 exit points before you enter the trade, you remove the need to make high-stakes decisions while your money is actually on the line. Step 5 is the risk-to-reward ratio. This is your final quality filter. You simply divide your potential profit by your potential loss to see if the trade is worth the attempt. This cheat sheet reveals the math of survival. You don't need a high win rate to be profitable. Look at the 40% win rate column. Even if wrong more often than right, you maintain profitability if your winning trades are consistently twice your losses. Step 6 is position sizing. This is the core rule of account survival. Professional risk management generally dictates never risking more than 1 to 2% of your total account on a single trade. This formula shows how to calculate your exact lot size. You take your total equity, multiply it by your chosen risk percentage, and divide that by the distance to your stop loss. This calculation ensures that even a string of consecutive losses cannot deplete your account, as every shot is limited to a tiny fraction of your total capital. We have now mapped out a 6-part framework designed to replace subjective market guesses with objective, repeatable requirements. Your goal is to have this checklist in front of you for every trade: setup, entry, stop loss, target, risk reward, and position size. Take this checklist to a demo account first. Commit to a rule where you refuse to execute a trade unless all 6 boxes are clearly and defensively checked. The market will always be a place of uncertainty, but your behavior within it can be consistent. This checklist is the tool used to ensure every trade you take is a calculated business decision.